We have futures moving slightly to the upside as investors look to tomorrow's CPI print before the bell for more clarity on rate cuts. The latest Fed fund futures indicating that investors see about a 50% chance that the Fed is going to cut rates by 25 basis points in June. Now, this follows mixed commentary that we have been getting over recent weeks from Fed officials. Most recently, Minneapolis Fed President Neel Kashkari floated the possibility of no rate cuts last week, while former St. Louis Fed President James Bullard said that 3 cuts is still the base case. So how much is riding on tomorrow's CPI print? What could it mean for the markets? We want to bring in our very own Alexandra Canal, Josh Schafer, getting ready for tomorrow's big print. Let's start with you just in terms of what this really means for the market, because like we started out that segment, futures, we're seeing some gains. We haven't really veered too far from the flat line. What could tomorrow's CPI print really mean here for the market moves?
Well, we can take a look back to the beginning of the year. We saw hotter than expected inflation prints for both January and February. And even though the Federal Reserve said that's ultimately due to seasonality, it's not the be all end all when we think about rate cuts, it did spook markets. And Josh, you highlighted some interesting market stats from February when that hotter January data came in. This is from February 13th. We saw the S&P close down 1.4%. The Dow Jones shed over 500 points. The NASDAQ declined 1.8%. We also saw a drop in the Russell 2000 amid a greater risk to small caps. So there was this intense reaction from markets following that hotter print. Always possible we could see that again tomorrow. Headline year-over-year inflation is expected to tick up to 3.4% in March. That's up from 3.2% in February. Core CPI, that excludes the price of gas and food costs, that's expected to see a slight deceleration to 3.7%, down from 3.8%. But, there's always that risk that we could get a hotter print, and that could lead to markets reacting quite intensely.
CPI is kind of the tone setter, right?
Yeah.
We know when
it's been the biggest driver of prices over the last year and a half.
Exactly, because it comes out first, right, Jared? And
yes.
While CPI and PCE, we've talked about this recently. I know Miles highlighted this in our newsletter, the difference in those two inflation measures and why they look so different when you look at them side by side. The trend has been relatively similar, right? When we see a big fall in CPI, you see a big fall in PCE, more or less to some extent, as far as trend. And so what has happened is investors get a little bit spooked when CPI comes out early in the month, and then it's, okay, should we worry about PCE also being sticky? And I think the prevailing concern with that tomorrow would maybe be we get a move up in the 10-year yield again.
Yeah.
We've been talking a lot about the 10-year recently. It's now, I think it's a little bit below 4.4. We're
definitely the highest of the year, and we're looking at 4.5%. That's something we haven't seen in quite a while, and it spooks investors sometimes. Anytime you see a big movement in the bond market, you can see risk aversion, and that can spill over into the equities markets. But Ali, I mean, what are some of the what are you honing in on some of the industries with respect to CPI and some of the expectations for not necessarily the headline numbers, which have largely flatlined, not even bottom out, but flatlined. What are you seeing in some of the industries?
Well, I do think we've seen stickier core services inflation, sticky shelter inflation. That's been the biggest driver of core CPI. So your rent is probably elevated. It's more difficult to buy a home, obviously, within this higher interest rate environment. And all of this is leading to that higher for longer narrative from the Federal Reserve. We have heard from some strategists whether or not this ultimately matters to markets at the end of the day. Michael Antonelli, he was on the show a few weeks ago, and he said, look, it might not matter if the Fed cuts rates at all. As long as earnings remain elevated, we're about to enter a new earnings season, that could prove well for the economy moving forward. And I know, Josh, you have that take as well. You're pretty bullish on the economy being strong.
The data is bullish.
We had
we have a resident analyst in-house. We don't even need to go outside for guests now. But this also really, and we talk about inflation right now, the fact that it is stickier, and we had just had Ines at the top of the show. She was talking a little bit about the move that we've seen higher in commodity prices, and I think more and more we have seen at least strategists, even though there is the argument out there that you guys have both been covering very closely, that maybe we don't even need a rate cut in order for the market to trend higher. But I do think this movement higher that we've seen in the price of crude and Brent and also in gold, that could potentially, especially Brent and crude, that could potentially push out any sort of improvement or at least force force inflation to kind of stagnate here at the current levels for maybe longer than anticipated.
Don't count out the ECB here, because the Fed is expected to cut rates, but the market doesn't seem to care that much that we've gone from expectations of 6 rate cuts all the way down to about 2.5 now. But if the ECB were to cut first, that would take some pressure off of the Fed, and it's increasingly looking like that might be on the table here. So you got to look at all the world's central bankers, because not one is operating in a vacuum here.
Our friends over the pond helping us out,
Yes.
Jared. How about that?
They don't always do that, but and vice versa. Sometimes central bankers are at odds, but it's been relatively coordinated, especially among the developing nations over the last few years. Japan finally late to the party by a few years, finally raising rates for the first time in almost a decade.
All right, so even if inflation comes in hot,
Yes.
maybe Europe can help us out. I'm a fan.
Good.
All right, that's a good angle. I like that.